2 years after the height of the financial crisis, there's still plenty the public doesn't know about what happened on Wall Street and in Washington, according to Joe Nocera, co-author of a new book, All the Devils Are Here, and a business columnist for the New York Times. Joe, thanks for being here.
Thanks for having me, Jack.
So you did all this research. You went back decades to show the true roots of this crisis. Is it possible to pinpoint the single worst mistake that led up to it?
No. And the reason it's not is because it took a lot of interrelated things to, in fact, interrelate. So subprime mortgages were one thing. Mortgage-backed securities were another. Deregulation in Washington was another. Derivatives were another. Wall Street was another. And it required literally a decade and a half to 2 decades for these different pots to come together into this toxic stew.
So do you think that toxic stew was the result of villainy or incompetence or a mixture?
Oh, it's all of the above. It is definitely incompetence, but it's also delusion, which is what happens when you get in a bubble and everybody believes something that's completely implausible. In this case, what was implausible was, A, that housing prices could only go up, right? And B, that you could bundle together the worst possible mortgages imaginable and call them AAA.
To that point, you get into something that I think is not at all well understood. In the old days, when a bank lent someone money, they held on to that mortgage.
Right.
But that all changed. Can you explain that?
Right. I actually think one of the seminal events that helped allow this crisis to grow was that once mortgage-backed securities is a means to buy loans from banks and S&Ls and ultimately mortgage originators like Countrywide so that they can have more cash to make more loans and so on and so forth. So in the old days, when the bank held the loan on its own balance sheet, the bank really cared about whether the person sitting on the other side of the table, you, were going to pay me back. But once you bundled into mortgage-backed security, once you sold a loan, and then, by the way, Wall Street sold the loan again to somebody else, and somebody else sold the link between borrower and lender was broken. And you got into this ethos where nobody fundamentally cared if the borrower could pay it back. And that negligence, and that's really what it was, had a lot to do with why this crisis took place, because they could give lousier and lousier and lousier loans, and they could say, oh, isn't it great? It means we're going to have a higher yield. It was a giant fee machine.
So what should we do to solve the problem? You're the king.
It's a hard problem to solve. Did mortgage-backed securities make credit more available to homeowners? Yes, it did. Is that a good thing? By and large, yes, it is. But you have to have the banks having some skin in the game. And you have to have a situation where derivatives, where the securities out of which these mortgages are made are appropriately regulated. And a big part of the problem was they weren't appropriately regulated. Nobody in Washington knew what was going on. And they allowed some really bad things to happen.
Does financial reform passed back in July move us toward that at all? And does financial reform even last? I mean, the Republicans ran on a platform of saying we're going to repeal it. Do you think they can succeed?
They're not going to repeal the financial reform bill. That they don't have the clout to do. But so much of the financial reform bill is still unwritten. That's the dirty little secret. The financial reform bill, the Dodd-Frank bill, really was a set of guidelines for the regulators to kind of fill in the blanks. So much of it depends on the kind of regulations that are written over the course of the next couple of years. The Republicans in the House are going to work their darndest to make sure that those regulations are as minimal and as narrow as possible. The Democrats are going to try to make them as broad as possible, and that's what they're really going to fight about over the next 2 years.
What steps would you like to see remain in there? How would you like to see them written to try to prevent this from happening again?
Well, I certainly think the Consumer Protection Bureau should be strong and not weak, because I do believe strongly that all the other agencies that had consumer protection on their plate didn't do their jobs. So I do think that's important, and I think there'll be a giant fight over that. I think derivatives need to be extremely transparent so that the government, so that regulators, so the Federal Reserve has a very clear idea of, how big the exposures are, who the counterparties are, what could happen if some company went under, or so that they know and they can take preventive steps ahead of time so that we don't have this, giant conflagration, for lack of a better word.
So one more question. Since you wrote your book, we've had a whole new chapter to the housing crisis,
We
the
sure
foreclosure
have. Yeah,
mess.
the foreclosure crisis.
How does this shake out?
I think poorly for the banks. I think the judges in the country are very angry about this. The big banks, the servicers, have created, it's almost like they created an alternative mortgage system which doesn't comply with the laws of the states and the counties that are actually in charge of mortgages and deeds. So yes, there will continue to be foreclosures, but they're going to be slowed down a lot because judges are going to want proof that the banks have the right to foreclose. And what the banks are saying is, well, there's no question that the person should be foreclosed on. Well, sure, but I can say that about you if you're my next door neighbor. That doesn't mean I can take your house.
Sure.
So there are due process issues that I think are very important, and I don't think the banks are going to get through this unscathed.
Joe, thanks very much for being here.
Thanks for having me. It was a pleasure.
And thank you for watching.